Ever wondered how a company manages its cash flow? Well, you're not alone. Cash flow management is an essential aspect of running any business, and it's all about keeping an eye on the money coming in and going out of the company. It's like the heartbeat of a business, ensuring it stays alive and thriving. Understanding cash flow management can provide invaluable insights into a company's operational efficiency. It tells you where the cash is coming from, where it's going, and most importantly, how much is being kept for future use. Now, the cash flow statement, the star of this process, has three main components: operating activities, investing activities, and financing activities. Each of these plays a significant role in determining the financial health of a company. So, want to know more? Stay tuned as we delve deeper into the components of the cash flow statement. We're about to take a fascinating journey into the world of business finance. Buckle up. First on the list, we have operating activities. This section is the heart of the cash flow statement. It's like a window into the company's primary business activities, the ones that make up its day-to-day operations. So, what exactly goes into this section? Operating activities include all the revenue and expenses generated from the core business operations. Think of it as the money flowing in and out of the company's main engine room. Let's break it down a little further. Revenue is the money a company receives from its customers for providing goods or services. This is the lifeblood of any business. For a retailer, this could be the cash received from selling clothes. For a software company, it could be the revenue from selling software licenses. Operating expenses, on the other hand, are the costs incurred in the process of generating that revenue. These are the resources the company uses up to keep its operations running smoothly. They include payments to suppliers for goods and services, salaries and wages paid to employees, rent for the office, utilities, and so on. There's more to it, too. Operating activities also account for interest payments and taxes. Interest payments are the costs of borrowing money. These might be payments on a loan or a line of credit. Taxes, as you might guess, are the amounts paid to various government entities. So, why is it important to understand operating activities? Well, they give us a clear snapshot of the company's core business profitability. We can see how much money the company is making from its primary business operations and how much it's spending to generate that income. Think of operating activities as the company's pulse. If the company is generating more cash from its operating activities than it's spending, that's a healthy sign. It indicates the company's core business operations are profitable. On the other hand, if the company is spending more than it's making from its operating activities, that's a red flag. It could suggest the company is struggling to stay profitable or keep its operations running smoothly. Operating activities provide a glimpse into the company's core business profitability. They're the first stop on our journey through the cash flow statement and a crucial piece of the financial puzzle. Moving on, let's talk about investing activities. This section of the cash flow statement can be considered the heart of a company's long-term strategic decisions. It provides insights into the cash flow associated with the firm's investments in long-term assets, which are often pivotal to the business's future growth and expansion. Imagine a business as a ship sailing towards the horizon of success. The investing activities are like the sails, the rigging, and the rudder that determine the ship's course. These include purchases or sales of long-term assets such as property, plant, and equipment, also known as fixed assets. When a company buys a new machine for its production line, builds a new office building, or sells an old warehouse, it's all recorded here in the investing activities section. But it's not just physical assets we're talking about. Investment securities also fall under this category. These are financial assets like stocks, bonds, or mutual funds that a company might invest in. When a company buys or sells these securities, it's also captured under investing activities. So, if our company decides to buy stocks from another company or sell bonds it had previously issued, those transactions are part of investing activities too. Now, why is this section so important? Well, it reflects the company's strategy for growth and how it's managing its resources for the long haul. A company spending heavily on new equipment might be gearing up for increased production, signaling potential future growth. On the other hand, a company selling off assets might be in financial distress or perhaps streamlining its operations. However, it's crucial not to jump to conclusions based solely on the investing activities. It's just one piece of the puzzle. As savvy observers, we need to consider it in the context of the entire cash flow statement and the company's overall financial health. Investing activities reflect how a business expands and grows its operational capacity. They give us a peek into the company's long-term game plan and how it's positioning itself for the future. So the next time you're looking at a cash flow statement, don't skip over this section. It's got some fascinating tales to tell. Lastly, we have financing activities to examine. Now, in the world of cash flow statements, this section is a little bit like the financial backbone of a company. It's where the nitty-gritty of how a company funds its operations and expansion gets laid out in black and white. Financing activities involve cash flow from, you guessed it, all financing activities. These can range from the issuance and repayment of a company's debt, to payments of dividends and stock repurchases. Let's delve a little deeper into these examples, shall we? First up, we have the issuance and repayment of a company's debt. This could be in the form of bank loans, bonds, or other types of debt instruments. When a company issues debt, it's essentially borrowing money, and this creates a cash inflow. Conversely, when the company repays the debt, it's an outflow of cash. Next, let's talk about dividends. When a company decides to share a portion of its profits with its shareholders, these are known as dividends. Payments of dividends are an outflow of cash from the company, as it's distributing its earnings back to the investors. Lastly, we have stock repurchases. This happens when a company buys back its own shares from the marketplace. The company might do this for various reasons, such as to consolidate ownership, inflate share prices, or reinvest in the company itself. Just like dividend payments, stock repurchases are a cash outflow. So why is all this important? Well, the financing activities section provides a clear picture of a company's financial strategy. It tells you how it's balancing debt and equity, rewarding its shareholders, and investing in its own growth. It can be a crucial tool in understanding the financial health and potential future of a company. As we wrap up this section, remember this key point. Financing activities illustrate how a business funds its operations and growth. They are the lifeblood that keeps the company's financial heart beating. They can be complex, sure, but with a little bit of decoding, they can be incredibly revealing. Now let's dive into the world of cash flow ratios and metrics. You see, these ratios and metrics aren't just numbers on a page. They're the vital signs of a business, the heartbeat, if you will. They tell us a story about a company's health, its ability to generate cash, and its potential for growth. So, what are these ratios and metrics we're talking about? Well, let's start with free cash flow. This is the cash a company generates after accounting for cash outflows to support operations and maintain its capital assets. It's like your take-home pay after you've paid your bills and maintained your lifestyle. The higher the free cash flow, the more resources a company has to invest, expand, pay dividends, or reduce debt. Next up, we have the operating cash flow ratio. This is a measure of how well current liabilities are covered by the cash flow generated from a company's operations. It's kind of like checking if you're earning enough to cover your day-to-day expenses. A ratio greater than 1 indicates that the company can pay off its short-term liabilities from its operations, which is a good sign. Last but not least, let's talk about the cash flow coverage ratio. This ratio measures a company's ability to pay off its debt from its cash flow. Think of it as checking if you can pay off your credit card bill with your current income. A high cash flow coverage ratio means the company can comfortably pay off its debts, which is a positive indicator for investors and creditors. So you see, these cash flow ratios and metrics aren't just for accountants or financial analysts. They are essential tools for understanding a company's financial health and making informed decisions. Whether you're an investor looking for a solid investment, a creditor assessing a potential borrower, or a business owner evaluating your company's performance, these metrics are vital. These ratios and metrics provide a comprehensive view of a company's financial health. In today's discussion, we've navigated the seas of cash flow management, from understanding the operating activities that reflect the core business operations, to unraveling the investing activities that showcase how businesses expand and grow. We've also decoded the financing activities, revealing how companies raise capital and pay off debt. We've seen that each component of the cash flow statement plays a vital role, painting a comprehensive picture of a company's financial health. We've also explored the importance of cash flow ratios and metrics, powerful tools that help us evaluate a company's liquidity, solvency, and overall financial performance. Remember, a keen understanding of these elements helps you see beyond the surface level of raw numbers. It's like having a financial compass, guiding you through the complex landscape of business finance. With this knowledge, you're now equipped to make informed decisions about a company's financial stability and future growth prospects.